Aspiramente. So, if you have one partner on a very high income plus shares and the other partner self-employed with a small business and ABN, does the self-employed partner need to change their business to an ACN to put it under the family trust? This is a really great question. Looking forward to covering this off. I'm going to go through a little bit of a case study. Now, this isn't advice. There are a number of situations and considerations that need to be had based on the specifics of the situation. So if you have a really good tax advisor, they can assist you with navigating this and making sure that you're doing it appropriately. So let me flip the camera around and give you a bit of a run through of the considerations. All right, so this is a pretty common situation that we see with family units. We see an individual here, PAYG, who is on a salary, high income, and receiving shares. And there are basically no tax planning that we can do for this PAYG person, aside from negative gearing or contributing to superannuation with concessional contributions. This is one of the downsides of being an employee, is that you don't have the ability to structure yourself. For example, you can't have your shares go to your family trust. You can't have your income go through a family trust. Essentially, you can only receive that in your own name, which essentially is how the sole trader works. A sole trader, they receive the income from the business, they incur their business expenses, and then any profits is taxed at their marginal tax rate. So essentially, there's no real tax planning that can exist. So essentially, the only thing these people can do is that from their respective surpluses after they've paid tax, they can utilize that and contribute it to a family trust, and then use that to buy investment assets, and then essentially have some flexibility around how that's distributed. But it doesn't necessarily provide them with the optimal structure. So here's what we may consider doing. Now, this will largely depend on the profitability and the size of this particular sole trader business. Usually as a tipping point, we would say that we look at setting up a company once we're doing over about $200,000 to $300,000 a year. And the reason for this is because this is at that point whereby the corporate taxation rate of 25% is going to be less than what the average tax rate is of the sole trader individual. And obviously we then need to consider what the distribution strategy is. So what will typically happen is that if we have a company, we're going to have the shares of that company owned by a family trust. The company's taxed at 25%, and if we make any distributions, it goes to the family trust. And the family trust gives us discretion and flexibility around how we choose to distribute that profit, okay? What we can also do is the PAYG individual can distribute any of their surplus that they've got after they've lived their lifestyle into the family trust, gift it into the family trust, and then that allows us to use that to buy investments. Now, every single year there is going to be surplus in this family trust, which will be made up of the excess profits and any income that is produced by the investment assets inside the family trust. And then we need to make a choice. Do we distribute that to individuals? So considering that we've got the PAYG individual, which I suspect that they're on the top marginal tax rate already, there's really no benefit of distributing to them because they're just going to pay the same amount of tax as they do personally. Now, the self-employed individual, they have a lower tax rate, so essentially we may distribute some money to them. But then we need to then consider if there's other beneficiaries that we can distribute to, adult children, or consider using a bucket company. And a bucket company allows us to have a flat rate of tax of 30%, and essentially meaning that we don't want to pay any more than 30% on average when it comes to our taxation. So the idea here is that the mechanism of the family trust gives us flexibility compared to PAYG, we have no flexibility, and the sole trader, we also have no flexibility. So this allows us to have that flexibility around distribution, and it also gives us some asset protection and control. So this is something, once again, you need to get advice on. All of these entities come at a cost of both setting up and then maintaining. So we want to understand what is the net benefit that these structures will provide you before we dive in feet first. This is why you've got to get the right tax advice, because a good tax advisor will help you understand your current situation, will get clear on what your goals and aspirations are, both personally and in your business, will help you construct a tax structure that's going to get you the optimal outcome and help you achieve your goals, and then optimize and improve and review that over time so we can add extra layers and make adjustments as complexity warrants it. Hope this answers your questions. If you've got any other questions, feel free to let me know. And if you're interested, jump in my bio, complete the financial performance scorecard so you can see how you're tracking, review your tax structure, what you're doing in terms of your tax planning, how do you manage your cash flow, and make sure you're making the most of your money in 2025. Any questions, let me know.